All right, in this video, we are going to talk about how to get whole life insurance right, specifically maximizing cash value for real estate investors. Real estate investors from the years of being in business are extremely attracted to cash value life insurance once they understand really the loan feature, and in the sense that once my money's in a cash value life insurance policy, regardless if I just let it sit and grow or if I pull it out, it is always at work for me. Huge opportunity and advantage there. However, questions often come up. We've got the same principles that apply where often individuals get into a product and then find out after the fact, wait a minute, this could have been designed differently, or there's a more flexible company. I could have had way more cash value up front, stronger guarantees, lower premium, more money going toward PUAs. Why was I not shown a more attractive option in the beginning? Or how do I prevent that from happening in the beginning? Because right here, I do not want to be taken advantage of, or I do not want buyer's remorse. So steps to take in order to make sure we have the right policy set up. Here we go. When examining the cash value, this is your goal. Policy design is the number one step. Where can the money go? Premium or the PUA component? Specifically, what should I look for? We're going to look at that in 2 seconds here. The other things I want to look at, company selection, and then also maximizing my flexibility. This, I've found, is particularly important for real estate investors because things happen. Cash flows are delayed. I'm selling a property, that gets delayed. The bank slows things down, whatever it might be. Things are out of our control often, especially in the early years. So what to look for? If I set the policy up right, what do I have? Safe, liquid, tax-free area to position money. Growth rate, somewhere between that 3 to 5% with no risk at all, not tied to the market no matter what happens, regardless of things going very well in the economy or things going very poorly. My value just continues to appreciate. Huge advantage in that respect. And then I can access my money without a lost opportunity cost. I continue to compound. So when I've got a properly designed policy, here's what I want to look for. Typically, in the first year, I should see whatever my total payment is, 85 to 90% show up in cash value right off the bat. If I pay in $100,000, 85 to 90,000 in cash value. If I pay in 10,000, 8,500 to 9,000 in cash value. It is possible to get that higher, by the way, as we've looked at in prior videos with some different types of products. Break-even point, number 2, between years 3 and 5. And then flexible. I'm not locked in to a high premium payment. If I have maximum cash value up front, that often means I have maximum flexibility. So if life happens, I'm not obligated to this huge payment. I can add money at my terms, not the insurance company. And then the 4 major mutual companies that have consistently delivered the strongest cash values to consumers. Big banks, wealthy corporations use them. They are the cream of the crop. So that's the foundation to set everything up properly before I start a policy. Now, how do I actually put it in action? How do I use the money? So with real estate, what do I have here? On the far left, if I have a piece of property that's appreciating at 5% every single year like clockwork, we'll pretend that it's worth $100,000. No matter what happens in the real estate market, that value goes up by 5% every single year. Today, it's worth $100,000. Next year, at 5%, it'll be worth $105,000. Now, if today I elect to take a loan against that, could be a mortgage, maybe a line of credit, whatever it is, if I pull out $50,000, what'll happen? Well, that $50,000 loan, interest is due on that. Where does it go? The bank, the lender, the institution I borrow from that I leverage the equity in my real estate with. Remaining equity, $50,000. Now, if I pay that back, my value's restored, and a year later, it's appraised $105,000. If I don't pay that loan back and I have the property appraised, what is the fair market value? $105,000. I get that appreciation no matter what on my entire home value. So, whole life insurance, this is where it clicks for so many people. Functions very similar to appreciating real estate. If I have cash value of $100,000, and I decide to borrow out $50,000. Remaining equity, $50,000. Policy loan, $50,000. Interest, the interest rate when I borrow from the policy goes to the insurance company. Just like with a piece of property, it would go to the bank or the lender. If I pay that back, next year cash value, $105,000. If I didn't touch it, if the appreciation rate was 5%, $105,000. If I don't pay it back, I still earned the 5% on the full $100,000 as if I never touched it in the first place. I constantly receive that compounding on everything. So, sounds neat. One thing I'll add, the interest rate with most insurance companies is often between 5 and 6%. Some are a bit lower. We're going to show you an example of that. But relative to what we can obtain from an interest rate perspective from a bank or a lender, loan rates are high with insurance companies. Here's a question that has come up very, very frequently, especially in the low interest rate environment we've been in with real estate investors and really everyone looking to leverage their policy loan, business owners and such, people that are really looking at the numbers. Common objections. Looking at the policy performance and comparing the net growth versus the loan rate on a policy. Not the dividend rate. This drives investors nuts from what I found. When someone tries to tell them, look, you've got a 5 or 6% dividend rate on your policy and you're loaning at 5%. Why it drives them nuts is that the dividend rate is not what we're actually earning on a policy. I want to look at the net growth. This can be referred to as the internal rate of return on a policy. What am I earning? Could be the average or the annual or both. We often like to look at. But what does that look like when I compare it to the loan interest rate? And then what is the actual spread? We're going to look at just that, and we're going to look at two examples because this comes up quite a bit. We're going to look at an example. It's a non-direct recognition contract, then also a direct recognition contract. With the exact same insurance company, this company offers both non-direct and direct recognition. This way, all of the assumptions are identical. There's no change. And then, I should add, what we're going to look at for when we're in a case where that loan rate is too high to the insurance company, we're also going to look at what is called a cash value collateral loan. If I could spell, there we go. All right, let's have some fun. So on the left, we've got a policy of an age 40 male paying in $50,000 per year for a period of 7 years. Could go longer, could go shorter. Break even. Or first, let's look at the first year. He pays in $50,000. Cash value right off the bat is almost $45,000. So about 90%, a little bit shy of 90%. Strong immediately. Between years 3 and 4, what's highlighted in yellow represents his break-even point. After year 7, just lets it sit and grow. Anytime we look at a leverage strategy, when we're taking a loan from a policy and we're paying it back, or if we're not paying it back, because we'll look at that frequently, I want to compare it to that same model of what my policy looked like if I never touched it in the first place. That way it's simple. I can compare and contrast, see the direct impact, cost of the loan, everything. Make it transparent for me if I'm the investor. So, annual internal rate of return, here we go. First year, about a 10% hit. The minimum premium is not showing up in cash value right off the bat. 10/90 split. As time passes, policy tops out the internal rate of return in this example, a little over 4%. This is based off of the basic dividend assumption. So somewhat conservative. We didn't index it or anything to try and make the numbers look better, which we could, but not for this example. So non-direct recognition, meaning the company will not recognize the fact that I take a loan out and pay the exact same dividend on any money in cash value and what I've loaned out. So here, we take out a loan at age 50. We can take a loan anytime we want. It could be the first year if we want to. Here, age 50, we're modeling it. What is the direct impact of that policy loan? I take the $300,000 out. The death benefit is collateralized. You will see that reduce when I compare it side by side. We did pay interest at the end of the first year, but initially our loan balance, $313,500. The interest rate here is 4.5%. So what I wanted to emphasize here, my point, is we pulled out $300,000, the balance accrued to $313,500, and if you have a calculator and subtract that death benefit by $313,500, you'll see dollar for dollar, it reduces from this figure on the left. What's it look like when I just let it sit and grow compared to the loan scenario? So when I take a policy loan, I will see a direct impact on my death benefit. The company is going to hold the death benefit as collateral. So if I die with a loan outstanding, they are on the hook for that much less. That is the reason they will continue to pay us dividends and interest on my entire cash value. So here's the beauty of it. This internal rate of return, a 4.14%, right, over 4.1% down here, is credited on any money in cash value and on my outstanding loan balance all the way through. Now, as we are repaying this loan example, specifically what we are doing is here, we've got the loan interest and we are paying it out of pocket each year. There we go. Now, the loan interest was 4.5% in the first year because we waited until the end of the year to pay it. This particular company, if we pay it all up front, bill's actually only 4.31% in loan interest, but still, it's over 4.25%. But we're paying the interest out of pocket each year, so as it's due, loan interest, we're paying it, loan interest payment. In addition, we are throwing $50,000 per year at the principal. So, at age 51, we paid back about $12,000 in interest, plus another $50,000 in a principal repayment, so the total payment is about $62,000 out of pocket. Now, here's what I want to look at. Look at year 19, and let me know what you notice about the cash value and death benefit. 618, 081, 618, 081. 100% restored to exactly what it would have been as if I never touched it in the first place. Okay, so I've been earning a little over 4% all the way through, annualized. This is not the average IRR. When it's paid back, here were the total payments I made. That's $357,630. So what I like to know in this case to try and simplify it a bit is, okay, I pulled out $300,000. That's how much I took in a policy loan. And when I paid it back, I paid the $300K back, but in interest payments, I paid back another $57,630 based on that present interest rate. That's high to me right now as I look at that relative to what I can get out in the marketplace. Compared to, here's an alternative here, that cash value collateral loan. So with these guys, what we can do is take a policy to a bank, to a lender, and say, hey, I've got this cash value here. I'd like to assign it to you as collateral in order to receive a line of credit. Very similar to leveraging equity against a property. The advantage to this is lenders often view this as loaning against cash, and we can get a very attractive interest rate. So here we've got it at 3.25%, might range between 3 and 3.5%. If they're large loans, it could be less. So same thing, we pull out that $300,000 loan. Here's the interest payment. We're paying it each year out of pocket, and then applying $50,000 per year toward the principal balance. Here's the main thing to look at. The policy is going to perform identical no matter what, because it's non-direct recognition. The difference is, what did I pay in interest? I took the $300,000 out, I paid it back, $300K in principal payments, and then, you can't see that, we paid another $34,125 in interest. So we did save significant interest expenses. Now granted, with this, I give up a little bit of control. I've got to pay interest-only payments to the bank or the lender. They can call it. If they do, I just borrow from the policy to pay it. That's the source of collateral. But some people aren't comfortable or they just don't like working with banks. Some people say, hey, I'm fine paying it back, especially if it's going to save me over 20 grand in interest. Sign me up and I'll pay it back however I want. It's a good option to be aware of. So that's a non-direct recognition loan. Let's look at the same thing with a direct recognition loan. We've got a 6% loan rate in this example. Identical policy as we look at this all the way through, same break-even point, same thing, year 19 cash value, $618,000. Here's the main thing I want to emphasize. The interest rate is 6%. We see that here. And then like the non-direct recognition example, if we pay it up front, we get a bit of a discount where it's 5.66%. Here's where individuals have a problem with this. And even if this loan rate was a clean 5%, I look at what I'm paying, say it's 5 or 6%, and then what I'm earning. Do I ever hit 5%? Maybe I index it to try and boost the return on it, but then I'm taking somewhat of a risk there. It's not really a risk, but still, I'm banking on hypotheticals in order to improve the return and force the model to work. That's where issues come up in the insurance industry. People are trying to use very favorable hypothetical situations, high interest rate assumptions, to outpace a loan. That's where people get into trouble, things blow up. So in this example, which we did not make aggressive deliberately, do I ever outpace the loan interest cost? No. Got a negative spread. If I add those two together or take the difference, it's about 1.5 points that I'm actually spending in loan interest if I split the difference there, but still, it's costing me. Now, here's the other difference. This is direct recognition, meaning when I take that loan out, the company is going to directly recognize the fact that a loan is outstanding, and what they do is I have a dividend rate of 5.65%. That's paid to any money in cash value. When I borrow, a dividend is still paid to the loan balance at 6%. They increase the gross dividend rate to match the loan interest rate, so it's a wash effect at the end of the day. But here's really what I want to look at. Interest payments. There we go. Principal payments. That total number there, 383, which means what? I paid back the 300 I took out, plus another $83,281 in interest costs. That's a lot as I look at it. Compare that to the collateral loan. This is exactly the same. Doesn't matter if I have non-direct or direct recognition because I'm going to a bank. 334, so I paid 125 in interest, where in both scenarios, I still earned this. So, is one better than the other? Depends really on our preference, just from experience, but it is good to be aware of different options. Real estate investors are interested in maximizing their liquidity. Give me the cash value up front. And long term, it's better than just having it in my bank account and using it for property purchases or investments as they come. Here, it's always at work for me, kind of like having it in an appreciating piece of property. But the one concern is when I crunch the numbers, if I'm negative, I'm not going to do it. No matter how much it might make sense in the long run, the numbers have to make sense to me for peace of mind. That happens a lot. So there are ways to leverage policies to accomplish that in today's low interest rate environment and everything going on. I do hope that this helps. If you have any questions, please feel free to reach out anytime. We'll talk to you soon. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.